You could be earning more, saving smarter, and building serious wealth, but are silent mistakes sabotaging your progress? Let's find out. Hey everyone, I'm Emma, and welcome back to the Wealth Mindset channel. If you're serious about financial freedom and want real, practical advice to master your money, hit that subscribe button and turn on the notification bell. Stay tuned until the end because avoiding just one of these mistakes could save you thousands of dollars. Mistake number 1. Ignoring the power of compound interest. Many people underestimate just how powerful time can be when it comes to growing money. Most people delay investing because they think they'll start once they make more money. But the truth is, waiting often means you lose the most valuable asset, time. Compound interest isn't just about how much you invest, it's about how early you begin. Time multiplies your money in ways most people can't even imagine. Jessica started investing at 25, while Daniel waited until 35. Even though she contributed the same amount, Jessica ended up with nearly double the return. Compound interest grows like a snowball rolling downhill. The longer it rolls, the bigger it gets. The sooner you start, the stronger the momentum. Start now. Even if it's just a little, your future self will thank you. The most powerful move you can make is to begin today. Mistake number 2. Trying to time the market. Even the smartest experts can't predict exactly when the market will go up or down, and guessing wrong can be costly. Lena panics when the market dips and quickly sells her investments, hoping to cut losses. But by doing this, she locks in her losses and misses the rebound. Mark, on the other hand, sticks to his investment plan no matter what the market does. His steady approach helps him ride the ups and downs and grow steadily over time. Emotional investing often leads to buying at market highs and selling at lows. It's a trap many investors fall into because fear and greed cloud judgment. Using dollar cost averaging, Mark invests the same amount regularly, regardless of market conditions. This reduces risk and removes emotion from the equation. It's not about timing the market, it's about time in the market. The longer you stay invested, the more likely your wealth will grow. Mistake number 3. Not diversifying your portfolio. Putting all your money in one place might seem easier, but it's one of the riskiest decisions an investor can make. Chris invested all his money in tech stocks because they were booming, but when that sector crashed, he lost a major portion of his savings overnight. Different sectors and asset types move differently, especially during economic shifts. Diversification means your whole portfolio doesn't rise or fall all at once. Ava may lose value in one investment, but her other diversified holdings balance things out. This protects her from major losses and gives her peace of mind. Diversification is not about missing opportunities, it's about protecting what you've built. It's a shield, not a limitation. Don't put all your eggs in one basket, spread your investments wisely. A balanced portfolio is your best defense against the unexpected. Mistake number 4. Following hot tips without research. Jumping into the latest trend without understanding it first is like diving into unknown waters. It might look exciting, but it's risky. FOMO, fear of missing out, can cloud your judgment and make you rush into investments. Tom hears a buzz online and acts immediately, without asking any questions. The internet is full of noise. Not every influencer or trending post gives sound financial advice. Without research, you're just gambling, not investing. Erica does things differently. She takes her time, analyzes data, and focuses on long-term fundamentals. Her calm, steady approach keeps her safe when others panic. Learning the basics helps you spot hype and see true value. Erica doesn't follow the crowd, she follows the data, and it pays off. If it sounds too good to be true, it probably is. Smart investors question, analyze, and move wisely, not emotionally. Mistake number 5. ignoring tax implications. Your investment gains may look great until you realize how much the taxman takes if you don't plan ahead. Michael cashed out his investments after a market win, only to be shocked by a massive tax bill. What he thought was profit quickly became a problem. Short-term and long-term capital gains are taxed differently. If you sell too early, you could pay much more than if you just held on a little longer. Sophie, on the other hand, uses retirement accounts and tax-advantaged strategies. She knows where to put her money so it grows without giving half away. Dividends and interest income are also taxed differently. Knowing your tax bracket helps you make smarter investment decisions up front. Smart investors don't just look at returns, they also factor in taxes. A smart plan now can save you a fortune later. Mistake number 6. Not setting clear financial goals. Without direction, saving money can feel like a never-ending climb with no view of the summit. Without goals, it's hard to stay motivated or even know if you're making progress. Nina keeps saving, but she doesn't know what for, and it drains her drive. Smart goals help you stay focused and driven. Specific, measurable, achievable, relevant, and time-bound. These aren't just buzzwords, they're a roadmap to real progress. Leo's goal is clear. Save $100,000 for a home in 5 years. He tracks progress and stays motivated because he knows exactly what he's working toward. Meanwhile, Nina drifts from one financial decision to another without clarity. She feels stuck, not because she's failing, but because she lacks a vision. Goals give purpose, focus, and discipline to your financial journey. Define yours today and start walking a path that leads somewhere meaningful. Mistake number 7. Letting fear hold you back. Fear of losing money or making a mistake stops many people from ever starting their investment journey. Carlos keeps all his money in a savings account, thinking it's safer, but over time, inflation silently chips away at its value, leaving him stuck. Isabel felt afraid too, but she started with small, manageable steps. She began reading, asking questions, and making small investments to learn by doing. As Isabel took action, her confidence grew. Fear slowly faded because she realized she was in control, not the market. Education is your strongest weapon against fear. The more you know, the less control fear has over your decisions. You don't have to be fearless, just take the first step. The journey to wealth begins with courage and grows with experience. These 7 investment mistakes might be common, but they don't have to be your story. With awareness and action, you can build lasting wealth. If you found this video helpful, please give it a thumbs up, subscribe to Wealth Mindset, and share it with a friend who's ready to grow their financial future. Which mistake do you see most often, or maybe even made yourself? Drop it in the comments. I'd love to hear from you and get the conversation going. This is Emma with Wealth Mindset, where we believe in the power of a wealthy mindset. Thanks for watching, keep investing wisely, and I'll see you in the next one.